There is now an increasing focus on how to prepare for and benefit from major market falls. Most large corrections occur within 8 years. We are now at year 11, and the longest since 1929 is 13 years. Typically, 30 to 50% of market value is wiped off within 6 to 12 months, and it takes 12 to 17 years to return to previous levels. Traditional asset allocation works well for most stages of the investment cycle, but not for large market falls. Traditionally, around 60% is allocated to stock and 40% to bonds, with the allocation to bonds increasing for more conservative investors. Risk-managed investing adds a protection piece, always in place, that increases in value to compensate losses for a hard-defined risk parameter. For example, like an insurance policy with a 5% excess, compensation is in place dollar for dollar below those levels. Our corporate expertise is to have the lowest cost protection always in place. Our proprietary software systems have a direct interface to the stock exchange and identify the lowest cost options by taking advantage of differing levels of implied volatility. To illustrate, you have a $100 million equity position. You decide on a 5% excess, that is, compensation dollar for dollar for any drop in value below $95 million. So, on a 10% fall, you would receive $5 million, on a 20% fall, $15 million, allowing for the 5% excess. After running our systems, the lowest cost available for a 5% excess for 3 months was 0.84%, or $840,000 to protect $100 million. This of course varies with market conditions and across time periods and excess levels. On 10% falls, the value of the protection has increased 6 times, or 600%, to $5 million. On 20% falls, by 18 times. Once the protection's in place, it's actively managed to maximise profits and minimise costs. Our approach on a 10% fall would be to lower the protection level and extract cash, typically 80 cents in the dollar. So for the investor, there would be $4 million cash and a protection level reset at 5% below the current then spot level. We apply this expertise to offer complete investment cycle solutions for equity income and for risk management. For equity income, our absolute return fund has operated on a 2% risk tolerance for 8 years now, delivering at least income of the cash rate plus 3%, which is currently over 5%, with our returns increasing as market volatility increases. This fund buys and holds blue chip shares with about 95% of its funds, and 5% are in the lowest cost protection piece. That is rebalanced and reset with market moves, as described earlier. We also operate under investment mandate, where, for example, a client uses its most recent dividend and puts protection in place for 6 to 9 months at around a 5 to 7.5% risk tolerance. Risk-managed investing is particularly important for number 1, late cycle investment, like now, and number 2, retirees. You can protect and benefit from major market falls by adding a small protection piece, always in place, that increases in value to compensate for losses.